Hello friends, I'm Vijay Bhambwani and through my videos, I've been trying to help you get a better grip on the markets because I've been trading these markets since 1986 and I've seen the ups and downs in these financial marketplaces. So last week I had to skip my weekly video, but I made good for it with my weekly Live Mint column, which is India's first and only media column to offer statistical inputs to its readers, and all the important aspects, the in-house oscillators, the ranges for the Nifty and the Bank Nifty, etc. were covered. So you did not really miss out on anything. We have an important event that occurred last week, which was the Honorable RBI Governor presenting his first Monetary Policy Committee meeting result announcement, and he cut rates by a quarter of a percentage point. And this is the first rate cut in almost 5 years by the Reserve Bank of India. Will this have a material change and impact on market sentiments? There is a special segment towards the end of this video. As usual, my video is divided into chapters, which you can please view at your convenience. You can also click on the setting button on the lower right hand side the window of the YouTube video and choose to view this video with subtitles in the choice of your language rather than me record this video in a few other languages. Now let's go to the regular features of this video, and on your screen right now is the weekly market roundup window, and what you can see is that the rally was led by the Bank Nifty because the rate cuts were obviously something that impacted the banking sector first. The broader based Nifty 50 brought up the rear, and the US dollar index, the Dixie, fell marginally against the other global currencies, but that was towards the first half of the week. In the last trading session of the week, the US dollar index has risen and the possibility of some more rallies is not ruled out. So overall weak US dollar index boosted gold and silver, which saw further safe haven buying, and crude oil fell for the third consecutive week, which is good news actually for inflation watchers. Natural gas went up along expected lines. Do remember, this is the winter season and this is the fuel of choice for indoor heating in Western nations. Now the USD INR, which is the United States dollar versus the Indian rupee, continued to rally, which means the Indian rupee continued to fall against the dollar. It's a new lifetime low against the dollar, which capped gains, but for which, had the dollar not risen against the rupee so much, our indices might have been a little more higher. The NSE market capitalization went up by 2 basis points only. This is against a slightly bigger percentage gains in the headline indices, which tells you that the broader markets haven't really risen as much as the index heavyweights have. The NSE 10-year benchmark, the Indian 10-year benchmark bond yield, I beg your pardon, on a week-on-week basis has lost, but on Friday, which is the announcement of the rate cut, the Indian 10-year benchmark bond yields rose pretty sharply. We'll come to that in the bond segment. The market-wide position limits rose routinely along expected lines, which happens every month after expiry. The US headline indices were more or less down, which provided headwinds to our markets, but for which our markets would have been higher even further. Now friends, I come to the ratio chart, and the Bank Nifty divided by Nifty 50 ratio chart tells us that this ratio tried to rally for the second week in a row and for the first time has closed above its 25-week exponential moving average, which is a proxy for 6 months, because 25 weeks is equal to 6 months. Now, I've been telling you that ideally speaking, for a sustainable rally, I would want this ratio to be above 2.35, if not 2.45. Why do I say that? Now, since I am not really a service provider or in any case offering any paid commercial services, I'm basically here to share ideas and share the reason why. The reason is here. As you can see, the weightage of the banking and financial sector is very, very high in the Nifty 50 itself. Now, unless you have this sector rising exponentially, a sustainable up move will be elusive. So high is the weightage of the banking and financial sector stocks that it is higher than the following three sectors put together, which is why in TradingView you should go to in the script name, type Bank Nifty slash or divided by Nifty, click enter, you get this ratio chart. You can do this for any two securities that you feel like. Now friends, I come to our in-house indicator and I start with MWPL. Please do watch this video about why I consider MWPL to be one of the most profound and one of the most important indicators. More importantly, you can plot it at home yourself. Now, the MWPL, as you can see on the weekly chart on your screen, rose to 31.93 from the prior post-expiry reading of 25.46. That's a smart move. That tells you that the buy and hold swing traders in the derivative segment have bought and carried forward their long positions in bigger quantities than they did in the prior two post-expiry weeks of the same duration. That tells me that hope was high. But do remember, this was before the RBI announcement on Friday of a monetary policy meeting that cut interest rates by quarter percent or 25 basis points. We need to see how this kind of unfolds in the week ahead. So MWPL is something you will monitor every day. Where do you get this data? Very simple. On my social media accounts. My contact coordinates are in the fag end of this video and in a pinned comment below this video. Friends, I now come to the stock and index futures turnover, and one look at this weekly chart spanning 20 weeks tells you a very, very forlorn picture. Going back in time, I found that this turnover of index futures, which you're seeing nose diving, and why am I using the word nose diving? Because it has actually hit a multi-year low. The total number of contracts traded in all index futures summed up to 8,14,108 contracts. This is abysmally low. This is the kind of turnover that is seen on two normal trading sessions. And remember, this turnover that I just mentioned is not of 2 trading sessions, but of 5 trading sessions for the full week. What does it mean? Now, there is a special segment at the fag end of this video wherein I will be sharing my strategy for the week ahead. I will explain to you what that really means. But turnover this bad, this low is not exactly good news. Now I come to the advanced decline ratio, and just as the Nifty clocked smaller gains, the advanced decline ratio also has come off its prior week's high. At 1.23, there are 123 gainers for every 100 losers, and that tells you that even though bulls were optimistic, they were kind of less enthusiastic as compared to the prior week. Now here again, this ratio is shared by me on my social media accounts in my post summation note to you. Please do connect with me there. Now friends, I come to the futures basis of the Nifty and the Bank Nifty. What is the basis? It's a premium or discount prevalent in the futures compared to spot. Just like options expiry, the basis also tends to erode over time. But all other factors remaining constant, higher basis is equal to higher risk appetite and vice versa. Now, the Nifty basis has come down by 50%, and the Bank Nifty basis has also come down sharply, though not 50%. That tells me that at higher levels, there was long unwinding. We'll have more corroborative evidence in the Nifty and Bank Nifty segment. Please bear with me. Now, friends, I come to the impetus chart. It's our in-house exclusive indicator. You won't find this anywhere on the internet. It measures momentum of any particular traded counter for that period in question. What you're seeing is the Bank Nifty, which actually clocked higher gains last week compared to the Nifty 50, saw its impetus fall. The Nifty actually clocked smaller gains, but the impetus was marginally higher. But net, the impetus reading was fairly subdued. That's not good news. I would have wanted the indices to go up forcefully, but maybe, just maybe, traders were waiting and watching for the RBI meet on Friday. So we need to watch this in the coming week. Here again, it's in the post-market summation note. Do connect with me there, please. Now, friends, for our in-house indicator, the lift, weight, thrust, drag index, you've been trusting it for almost 4 years now, and it stood the test of time. Last week, I told you that the impetus had risen to 0.39, which means the indices could possibly go higher, and higher they did. I did not record a video, but it was there in my live mint column, which I shared with you. Now, the impetus has fallen to minus 0.03. That tells me that follow-up buying, fresh follow-up buying, may be actually subdued. Sure enough, short covering can come at lower levels, but short covering can only slow down a decline. For logging a new all-time high, you can't depend on short covering alone. You need fresh buying. So be careful out there. Buying in the next week, in the coming week rather, is likely to be a little subdued. Now, friends, I come to the bond market. There will be more in that special segment about whether the interest rate cut will help the markets or not, but this segment is for the bond market, which is very close to my heart. I've been covering bonds ahead of equities for many years because this is a segment that funds the price discovery mechanism of the other asset classes. Now, on the face of it, the Indian bond market seems to have just about closed the week with yields barely moving at all. But like a duck appears calm above the water, but its feet are furiously paddling in the water below the surface. A lot was happening in the bond markets last week. Now, the yields were fairly subdued till Thursday. As soon as the RBI governor announced the rate cut, bond yields started showing signs of coming to life. They just erupted out of their hibernation. And boy, oh boy, what action. 4 and 5 basis point rally and in double quick time. And that was telling me that bond markets are expecting excitement ahead. More in that special segment. But sum and substance, what would I be doing with this kind of yield? Would I be buying 10-year benchmark bonds? No. Am I going in for gilt funds? Not at all. I'm keeping the powder dry. Remain assured, whenever I decide to move in the fixed income market, deploying money in either Indian 10-year sovereign benchmark bonds or on gilt funds, I will happily update it on my social media accounts. Friends, the bond market's done. I now come to the Bank Nifty, which stole the thunder from the Nifty 50. It gained relatively higher than the Nifty last week. And as the daily chart on your screen tells you, this index actually rallied on 3 out of 5 trading sessions last week, with Tuesday and Friday being the big moving days. The price remained above the monthly average, which itself is pointing upwards, and the neckline of an unconventional head and shoulder pattern. So these are multiple points of support. The Bank Nifty remained above these supports. That makes the near-term outlook somewhat positive for now, provided follow-up buying emerges in the week ahead. Now, that is a conditional caveat that you need to remember. Staying above the weekly high of 50,642 or rounded off to 50,650 on a sustained closing basis will also help matters improve sentiments further. Now, let's move to the weekly chart, which shows a second bullish candle in a row, albeit the candle itself of last week is smaller than the prior one, and it has a noticeable upper shadow, which means some amounts of unwinding at higher levels was seen. The price is below its 25-week exponential moving average, which itself is turning downwards. This moving average is equivalent to 6 months of holding on cost of an average trader. So the medium-term outlook is cautious for now. Now, that can change if the 50,650 level is overcome forcefully and the price stays above it sustainably. Now, friends, in the week before last, this index was number 7 on the most volatile counters list as per statistical beta rankings I maintain in-house. It rose 2 notches to number 5. Volatility going up is not a great sign. It poses challenges to an average retail trader. Now, last week in my live mint column, I advocated a range between 51,400 on the upside and 47,775 on the downside, which held perfectly well. In the coming week, I estimate a range between 52,025 on the upside and 48,275 on the downside. Friends, in addition to these ranges, also please note our daily, weekly, and monthly pivots that I share on our free Telegram channel and WhatsApp channel as well. And also check out this tutorial video about how to use our pivot points better, which levels you will use for entry and exit, and laser precise your trading pattern. Friends, the Bank Nifty done. I now come to the Nifty 50, and as the daily chart on your screen tells you, this index rose 0.22% and clocked only 1 day of gains out of 5 trading sessions, Tuesday being the most prominent day of the week. The price is above its monthly average, and the monthly average is pointing sideways and yet to break out above the descending triangle, which is marked with the red trend lines, which means higher volatility at advances. Now, the weekly chart shows a second weekly green candle, but with an even more prominent upper shadow as compared to the Bank Nifty. That means selling at higher levels was noticeable on the Nifty 50. The price is below its 25-week exponential moving average, which doubles up as the 6-month long holding on cost of an average trader, which means the medium-term outlook is nervous for now. We need to trade above the 24,000 round figure mark, and that too on a sustainable closing basis to change the outlook for the better. On the flip side, falling and trading below the 23,200 mark means more downsides in store. In the week before last, this index was number 18 on the most volatile counters list as per our statistical beta rankings. It rose 4 notches to number 14. Here again, not a good sign. Last week, I advocated an estimated range between 24,125 on the upside and 22,850 on the downside, which held perfectly well. In the coming week, I estimate a range between 24,225 on the upside and 22,875 on the downside. Here again, please watch our daily, weekly, and monthly pivot levels. Also, the video that explains you how to use these pivots better. Friends, I now come to the last bit of statistical analysis, wherein I share with you the retail risk appetite in the 4 derivative segments. And what you can see on the weekly chart on your screen is the index futures turnover contribution fell 12 basis points. The stock futures turnover contribution fell a whopping 1.06% or 106 basis points. Now, futures demand a lot of capital outlay, and they are more riskier and volatile. The turnover contribution falling in this segment tells you that risk appetite contracted. Index options turnover went up by 290 basis points or 2.9%. Now, this is the safest in terms of volatility and lowest in terms of capital requirement. Very clearly, traders were going long, but they were going long in the most safe segment out of the 4 derivative places. That tells me that they were taking a very, very cautious approach. The stock options turnover contribution fell a whopping 171 basis points. Net, I would say that the risk appetite was fairly subdued. But let's give the bulls a benefit of the doubt. Last week we had the interest rate decision on Friday. Will this week be any better? Let's see, time will tell. Now, friends, for that special segment about whether the RBI rate cut will help or not. I have been telling you since October 2021 that I expect the cost of funds to go up. I've written hundreds of posts on my Telegram channel, which is the only place where I can share all my research and data output, because it allows me to upload files of various formats, PDFs, Microsoft Excel data files, share a lot of research with you by way of reports, etc., which other social media platforms do not allow me to attach these files. So I've been telling you that cost of funds will go up, and will a mere cut of 1/4% really help? Now, if you go back to your high school economic lectures, you will understand that there are 4 factors of production: land, labor, capital, and entrepreneurship. Do you think that a 1/4% rate cut in one of the 4 factors of production will be enough to transform the outlook of the entire stock market? That's a question you need to ask yourself. The second is a bigger and deeper question, and this is something that I have shared with my online family on my Telegram channel. This is based on the behavioral finance approach called weight of evidence. Remember, I'm basically trying to share the reason why rather than trying to sell you any service. I don't offer any paid services here. So this weight of evidence approach is also called the Vyacheslav question. It is named after one of the toughest negotiators the world has ever seen in realpolitik, Vyacheslav Molotov, the foreign minister of Joseph Stalin during Second World War. Now, allow me to tell you a short story and you'll learn a lot about bargaining in the financial markets. Now, before the Second World War started, Hitler wanted to take Stalin out of the equation by signing a peace treaty with Russia so that they would not attack each other while Hitler conquered Europe. So, the German foreign minister, Joachim von Ribbentrop, had invited Vyacheslav Molotov to Germany to kind of convince him to tell Stalin to sign a peace treaty with Hitler. Now, the British intelligence somehow came to know of this Molotov-Ribbentrop meeting, and they convinced their allies, including the Poles, to start a bombing raid overhead over the location of the Molotov-Ribbentrop meet. Now, Ribbentrop, the German foreign minister, was trying to convince Molotov, who refused to speak. That was even more spooky. You're trying to talk to somebody and the other guy is not responding. He said, look, we've almost won the war. Remember, this is the beginning of the war itself. We've almost won the war. Hitler will get his victory in the next 2 or 3 weeks. Then you will not have too much to bargain. You will have to sign wherever we tell you. Why not sign now when we are still going to listen to you and kind of accommodate you where you have certain conditions? So please sign now. Now, Molotov kept on refusing to commit, refusing to speak, and suddenly you have the Allies bombing the German location on top. They were rushed to an underground bunker where the German foreign minister again started, sign the treaty now before it's too late. Vyacheslav Molotov finally spoke. He said, if you think you're winning the war, if you think you've already achieved your objective, whose planes are bombing you overhead and why are we running down like mice in your underground bunker? Joachim von Ribbentrop, the German foreign minister, had no answer. Now, whenever you're confronted by a situation that demands a decision from you as to whether an event is going to have this outcome or this outcome, the possible answer is a weight of evidence or a Vyacheslav question. My answer to you whether the bond market is convinced about the rate cut is in the daily chart of the Indian 10-year benchmark bond yield. You can view that on TradingView by typing IN10Y. IN as in India, 10 is the 10-year benchmark bond, Y is for yield. Now, when you type IN10Y and see the daily chart, you will see a 4 basis point spike in the Indian 10-year benchmark bond yield. Why? Now, bond markets are one of the most sensitive, radar sensitive to interest rates. If these guys are telling you we are not convinced, hey, I'll go with them. Billions of rupees go into moving the bond yield by 1 basis point, and that has moved 4 basis points on Friday. You want to give it a benefit of the doubt? Fine, let's wait for Wednesday, let's wait for Thursday, let's wait for Monday, Tuesday, whatever. You want to wait for 2, 3, 4 days before taking a call? Sure, take a call. But the fact remains that the biggest players in the bond markets are banks, and the banks are most impacted by a 1/4% rate cut, and they were not convinced. Why did the bond yield spike? Because they sold bonds. Why are they selling bonds? Because they're not convinced rates will not rise further. So I rest my case as to whether a 0.25% rate cut or 25 basis point rate cut will actually turn sentiments around as if in magic. Now, I come to my trading strategy for the week ahead. It's going to be short, it's going to be sweet. I continue the theta decay approach, and I will primarily target the interest rate sensitives and high MWPL heavy counters that are relatively vulnerable to crowded exits. Now, the reasons are that bulls are trapped at higher levels. I have told you time and again in my previous videos, every month the Nifty has shown after June 2024, every month the Nifty has clocked at least one sharp decline, thereby hitting the bulls with mark-to-market payments and throwing many retail guys out of their trades. So, what they have done is they've shifted from futures to options. How do I know that? Look at the turnover contribution of options. It's gone up to levels I have not seen in years. In years, 3%, 3.5%, 4% in options, never seen. All right. Now, I have recorded a short YouTube short video many months ago about how to interpret the fact that traders are moving from futures to options. The link to that video is in the description and in the pinned comment below this video. Please do make it a point to watch that video. Now, I told you that the turnover in index futures at 8,14,108 lots is the lowest weekly turnover in many, many years, and it will hit you hard. Why did I say that? Now, we traders, we doers of deeds, real world traders, live and die in what you're seeing on your screen. This is called a snapshot window. Most trading terminals, and I'm talking of full featured desktop trading terminals, will bring up this window when you highlight any stock and click on F5. So the syntax is F5. This snapshot window shows you the top 5 buyers and top 5 sellers. Now the difference between the top 5 buyers and top 5 sellers is called the spreads. Now when you see the spread, the finer the spread, the better it is for you. Why? So if you have the difference of say 2 tick prices. Now a tick price is 5 paise. That is for a security trading above 500 rupees. Now let's assume that the difference between the bid and offer spread, the top bid and offer spread is 1 rupee. You buy something, you want to sell, you can get out of it immediately at 1 rupee lower. So your loss or transaction cost is 1 rupee plus other transactional taxes, etc. What if the spread was to widen to $5? You make a mistake, you enter into something, you want to get out, you'll have to pay a 5 rupee penalty to get out. What would you rather like? Would you like wide spreads or would you like narrow spreads? I would prefer narrow spreads because my take-home profits are going to be higher. Now, what happens when volumes collapse to multi-year lows? The spreads will widen. This is something that you need to understand as real-world traders because non-market participants are not going to tell you this. We need to be extra careful out there. We need to basically calibrate our footprint. Our ingress and egress, entry and exit has to be very, very well timed. We are now going to be treading or walking on landmines. It's not going to be easy, but it's going to be done. I also maintain my view that energy markets are well supplied and talks of super cycle are something that I continue to debunk, which I have been doing since 2021. Higher levels will encounter resistance in prices and industrial metals in the week ahead may just see some more upside, which means metal mining counters might just see their stock prices undergoing some cheer. But do not go overboard and go all out on traded volumes. I have been basically telling you in a video that do not max out. Position sizing, like I've said in this video, is very, very important. Now, bullion as a long-term strategy is playing along on expected lines. I'm very, very happy. I've been bullish on bullion for years. Now, I hope you watched this video. It's one of a kind of a video which I have not seen people come out in the public domain. I have shared leading pointers to you about how to buy the purest quality gold and silver from the most reasonable priced wholesalers in your city, how to get it evaluated, tested for purity, and make payments with proper bills, how to negotiate buyback agreements with the guy you're buying bullion from so you can sell it back to him when you want to book profits. Do watch this video, please. As also, this video which I had recorded a couple of weeks ago about why I'm so bullish on bullion. Friends, before I wind up this video, I have a request. Now, although I don't charge any money and provide any commercial services, these videos require a lot of effort, time, and money. I would be thrilled if you could help my endeavor to reach out to a wider audience by sharing my videos with all your friends, your family, and social media groups on across social media platforms that you are on. I would be able to help spread the cult of knowledge-based investments and trading. The more I can reach out to people, the better it is. My channel was, is, and will always remain free. Friends, if I have any more ideas to share with you, I will gladly do so on my social media accounts. So do take the time and energy to connect with me. I thank you for your patience in being with me in this video. If you haven't already subscribed to my channel, please do so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know what you think about my work and how it helps you become a better trader, and what else I can do to help you understand the market better. Thank you for your patience. I wish you have a very, very profitable week ahead. Take care. Bye-bye.